Look, we heard about the elusive holy grail of synchronized global liftoff from the IMF, still remaining very, very elusive here. And the IMF basically reaffirming the Fed's decision not to lift rates in September.
Yes, absolutely. The IMF has been very, very consistent in terms of its advice to US monetary policy makers not to go too early, not to be preemptive, see the whites of the eyes of recovery, if you will. It's not my opinion, it's not the Westpac view, and I think that the broad consensus of economists did think the Fed has missed a window, but it's very, very easy to sit back and respect what the IMF is telling us. But on a bigger picture scale, we have had a change of chief economists at the IMF. This is Maurice Obstfeld's first World Economic Outlook in the chair, and he's really put his stamp on the IMF's framework. A year ago, the IMF was focused on a terms of trade boost to the advanced economies. Lower energy prices was going to boost the US consumer. This year, we have exactly the other side of that coin. We have an IMF talking about the risks to commodity exporters from the terms of trade drag. That's a very, very important philosophical difference.
And the thing is, we saw those concerns in Malaysia and Indonesia as the Rupiah ringgit sold off until recently.
Well, absolutely, and I don't buy this recent rally in emerging market currencies at all. FX markets tend to lurch to the very extreme of any shift in the fundamentals. Everyone was extraordinarily short 2 weeks ago. They didn't get the Fed, and there's been a lot of position covering, a little bit of excess exuberance, if you like. But Malaysia is still extraordinarily exposed to foreign investor bond outflows, and Indonesia has had a 2 to 3 year drag in its terms of trade. It shot itself in the foot with the prohibition on the export of mineral ores, and I don't have much good to say about either of those two economies right now.